Hey, it's Eric with the Future Mill. Have you ever wanted to start investing, but when you actually log into your account, you see that you can invest in stocks, bonds, index funds, mutual funds, and ETFs? There are so many different options out there. Well, in this video, I want to teach you index funds, mutual funds, and ETFs. What's the difference in these three? And also, what are the similarities? Let's do this. Let's be serious. Index funds, mutual funds, ETFs. You go to talk to an advisor, one has one that they're going to pick, one has another. But to be honest with you, there are a lot of similarities when it comes to these. You see, they're all pools of stocks. An index fund is a pool of stock, a mutual fund is a pool of stock, and an ETF is a pool of stock. So that's a big similarity that they have, but they trade different. A couple of them trade one way, ETFs trade another. Then you have the fact that some are actively managed, some are not, some are based on an index, some are based on a sector. So let's start with mutual funds. Mutual funds are a basket of stocks with an active manager tied to them. Now with an active manager, that means that they're going to be buying and selling different stocks within the mutual fund on a regular basis to try to outperform the market. Now this could work sometimes, but sometimes it won't. According to a CNBC article, the majority of active fund managers have not beat the S&P 500 over the past 9 years. So it comes into play when you start figuring on mutual funds and how much you should be looking at them, because there is a high fee on the back end of mutual funds for the active manager. When it comes to trading mutual funds, they do not trade like a stock. If you see a stock price for ABC stock at $100 at 2 p.m. during the day and you buy it, you would buy it for $100. When it comes to trading mutual funds, they do not trade like a stock. For stocks, if you see a stock price at 2 p.m. for $100 for ABC stock and you purchase it, you buy it for $100. Well, remember, mutual funds are a pool of stocks, but let's just say that ABC stock was also in your mutual fund. If you thought you were going to buy it for that $100, you actually have to wait until after the trades have all settled for the day, and whatever the final stock price is, that is what the mutual fund is going to buy that stock for. So if the stock went up to $120, that's what you would pay, or if it went down to $80 at the end of trading day, that's what you would pay within the mutual fund. Now remember, you're not just buying a single stock, but at the same time, this does give you an idea of how stocks are priced when it comes to the mutual fund. Now let's talk index funds. Index funds track an index. So think of the S&P 500 or the Dow Jones or the NASDAQ. These are indexes. The index fund is going to track the index, and they are significantly less in price because they're not actively managed, and instead they're just tracking an index. Now where people get confused is they think index funds trade like a stock, but actually index funds are mutual funds. They just don't have an active manager tied to them, so their fees are drastically less than if you were paying an active manager with a standard mutual fund. But just remember that index funds don't trade like stocks, they trade like a mutual fund. For ETFs, they're also just like a mutual fund or an index fund. They are a basket of stocks, but when it comes to them, they don't trade like a mutual fund. They trade like a stock. So you can get in and out if you need to during a trading day. One major difference between ETFs and mutual funds is that mutual funds have an active manager, but ETFs do not. This allows the ETF to have a less of a fee than the mutual fund, but oftentimes ETFs do have a higher fee than the index mutual fund. I know it's a lot of different things when it comes to this and can get a bit confusing. But the nice thing about ETFs are they can track an index just like the index mutual fund, or you can actually buy a specific sector. So if you wanted to buy in the real estate industry, you could do that within an ETF. Or if you wanted to buy in the financial industry or healthcare, there are specific ETFs that track sectors. Now ETFs are starting to get more sophisticated, and sometimes the fees are starting to creep up on those because there are options traded in different things within the ETF. Now, mutual funds have been doing this for a long time, but it's starting to drip into the ETF industry as well. So that's a real quick breakdown of what an index fund, mutual fund, and ETF is. I'm not telling you which one to invest in right this minute because everybody has different opinions on these, but I will tell you what I personally use for clients oftentimes is ETFs. I'll sometimes drip in a mutual fund where it's needed, but I like the idea of ETFs for myself and my clients when it comes to investing because it has a lower fee, but we can also get more specialized when it comes to picking out our sectors, and we build out an asset allocation model. If you have any questions about investing, go to thefuturemill.com and click Get Started, book a call with us, and we'll be happy to talk to you. As always, thank you so much for watching. Please be sure to like and subscribe. You don't have to smash a like button. All you have to do is just tap it. Tap it real easy. All right, thank you.